Morning, Chris.
Hey, good morning, Brian. How's it going?
Good, good. I'm Brian Jones. I'm here with Chris Hood, world's most interesting man, professional trader. And
Whenever you say that, I get this conflict that happens in my head. I get told I'm the most boring person that's ever lived, and I live in a very boring place. It's like, come on, man.
I don't know. I think what you're doing is interesting.
Oh man, I don't know. With me and my knee, I think that I'm probably the world's most boring jiu-jitsu guy that happens to just trade on the side. But the thing about injuries is that it forces you to do something else. Otherwise, your mind just centers on that, right? So,
Right.
you know,
Yeah,
there's a silver lining to everything.
you can make the most of an injury. I tore my bicep and I had to have it repaired, and it took a while. So I played one-armed guard with my arm tucked in for like 8 months.
I don't know if I could do one-legged jiu-jitsu. I've thought about it, and it would just look really weird. So I
Yeah,
think
the leg's a little different. The knee's harder. I mean, it's
it,
a brace.
I landed up doing. I was training karate. I was doing karate on Saturday, and I couldn't do any kicks. So I landed up just standing dead still. And what we do a lot of bag work in our karate. So I was just standing dead still in front of a bag, throwing bombs, and it was quite weird because you land up not mechanically doing it correctly. You can't swing your hips as much as usual. So it was, pretty weird. So I don't know, man. I just want this thing to repair. But I realize now at my age, repairs take a hell of a lot longer than they did when I was 18, man.
Yeah.
Like,
No, I mean when you get injured, it's rough. It
yeah,
takes a while. So it's all about finding ways to work around stuff.
I think I'm going to just say, let's leave the no-gi stuff to the guys who've got lubricated joints, who've got a lot of, cartilage and all of that stuff is in good supply. And give me something where I can hold on to someone. Give me gi. I'll handle gi. I don't see anyone going for my knees in gi. So,
Yeah, it's less likely for the knee.
yeah, I think I might just stick with the pajama wrestling and, stay with that for a while. Yeah, no, give that a miss.
So
Yeah.
what's going on with the market? What do you see?
And yesterday was a very interesting day because the market opened down. It had this big gap down. And, for whatever reason, Afghanistan. By the way, did you see the footage of the
A little
plane?
bit. Yeah. It's
And it is soul destroying. Absolutely tragic. I mean, those two guys that fell off the plane when it was taking off, and you see them dropping to earth. I'm like, man, how many trillions of dollars were put there, and in a matter of 9 days, it was all gone. And now we have to listen to those clowns. I mean, anyway, don't get me on the political thing. I was almost in tears yesterday because you start realizing how fortunate we are to live in a world where we have freedoms, whatever freedoms there might be. And you listen to what these guys are going to have to go through again, and they're pretty much on their own, and it's just really sad. But anyway, okay, enough of my political
do you
side.
think that had an effect on the market? You think people
I
were
think it did. I noticed this morning that in the Globex session, there tends to be these spikes of volatility that then get washed out during the normal cash session. So I'm thinking at the moment, it's pretty normal for this type of trading pattern for this season of the year, right? So it's not unusual. Last year, October, if you go back and have a look at your journal, if you've been keeping one, you'll notice that this time of the year, liquidity starts to get sucked up a little bit, and the trading patterns tend to become far quicker. So as we start seeing these moves in the overnight market that then get washed out in the cash session, it's important to really focus on easy money trades. It's if you look at it, the main problem that a lot of novice traders have is that they end up doing too much. This is the thing. It's like, let me just land up and put on everything, because I'm going to hit the ball out of the park on every trade, right? That's exactly how a
shotgun
beginner,
approach?
huh?
Shotgun approach. The shotgun approach. You just
Yeah, it's like let's just spray bullets and see what happens, right? And the problem with that is that there's no focus. And because there's no focus, you start landing up doing hard money trades. I call them hard money trades because it's work. At the end of the day, this is supposed to be simple. It's not supposed to be complicated, right? So they tend to go and trade, if you had a choice between trading, say, Peloton or Roku versus XLK, the ETF for the sector, right? You've got those three choices. Which one would you take? It's far sexier to go to a local neighborhood barbecue and say, hey, I made so much money on Peloton or Roku, right? No one really wants to go and say, hey, I made 100% on XLK, the ETF for technology. It just doesn't have a ring to it. And that's the problem that a lot of beginners have, is that they go and chase these hard money trades. Making money on Peloton and Roku and all of these stocks, it's difficult work. It's hard work. At this time of the year, it's a lot harder than it would be, say, in October or November. So, beginners need to start focusing at this part of the year. What you don't want to do is land up over trading to the point that all the good work that you've done up to now gets lost. And then the sort of return to the market, the sort of bull market we have just before Christmas, that sort of uptick that we get, you're making back everything that you lost. So you land up at the end of the year at a zero. I mean, that's generally the trader's calendar, right? It's make money at the beginning of the year, lose it at the end of the first quarter, battle through summer, make a little bit more, break even, make a little bit, and then lose it just before the fourth quarter. And then by the start of the fourth quarter, mentally you're shot because you've been through these highs and lows. You haven't got much on the P&L to say, hey, this was a great year. And then you miss out on the Christmas rally because you say, you know what, I'll start again. That's how beginners think, right? They don't plan their year ahead. They don't actually manage their P&L. So focus on easy money trades, right? At this point, with the market grinding to highs, you need strategies that are actually going to extract value. It's going to be very difficult to do strongly directional trades like long calls, for example, in the short run. In the long run, they'll work if you get the timing right. So you don't have to buy, these short-term expiration options. You need to be buying longer-term expiration options. But the main thing here is credit spreads. If you can play the volatility game where things are range-bound and you start doing things like iron condors, you could be doing iron flies, you could be doing put spreads, you could be doing any of those things, call spread, credit call spreads on the one side, you could do bull put spreads on the other side. Understanding ranges, man, this is the time that you just extract premium. But with those, you've got to bring the time frames closer. Can't do them long range. You've got to do them short range. So that's the thing that most beginners fail to plan. Okay, what they would have been doing is going, well, I've been making a lot of money on, long calls. I'm just going to stick with that. And they keep applying that strategy into a market where the conditions aren't warranting that strategy. So I was talking about this a couple of days ago with my subscribers, where I was saying to them, you could trade the best strategy on the worst possible stock and lose horribly. So pick the right stock. Even if you had the worst strategy on the right stock, you could still come out with some money. All right. So the stock is important. So pick the easy money trades, go with the sectoral ETFs. You don't have to watch 5,000 shares every day. Have a small condensed list and understand where relative outperformance exists. If you don't trade the right sector, so, just because you might like energy doesn't mean you should trade it. Let me share my screen and I'll show you a couple of things that I can show you on how I look at relative outperformance. So when you look at the screen, you'll see a lot of columns, right? And what these are is you look for the columns that have got the most green. It's pretty, I'm not that smart. So I have to look at things where I can make it idiot proof for myself. So what I look for is the most green. So if I've got green, no reds, yes, green. Okay, well, XLP clearly is identified as a possible opportunity. We go over into TradingView, type in XLP, we look at the stock and we go, oh, well, there is our alpha score indicator. We have a buy signal. It's currently in a buy mode. It hasn't been offset yet. Now it comes down to your strategy and you go, well, I've got a buy signal. I can still enter the trade as long as the last signal was a buy. Now, would I be comfortable buying at this price point? No, I would rather be buying somewhere down here at 71.38. Now, 71.38 is not far away from where we are now. All right, this doesn't look like it's in scale. All right, so when people look at this, they go, oh, look how far it's extended above the 34. You would go, okay, well, I'm just going to wait for it to hit the 34, or I'm going to wait for it to hit the 8. It all comes down to your strategy. All right, now we've identified where there's a stock with relative outperformance. We know that it's got that because it's got all those greens. What we want to do is avoid trading in the areas where there's reds. All right, so we don't want to be going into gold just yet. We don't want to be doing anything with gold miners or XBI. This is an interesting one. XBI and IBB. If you look at XBI over here, we've got red, squeezes below. And if you go to IBB, which is this, if you look at the name, biotech ETF, why is one red and one green? It's really interesting, this, because this is where a lot of guys get foxed out as well, is that they don't go into the ETFs themselves to understand what makes it up. So when you look at IBB and XBI, we go through to very simple tool here. I actually was doing this morning. So if you look at IBB versus XBI, same sector, everything. Look at the differences here. You've got in XBI, you have a very equal weighted approach to all the stocks within the sector, 197. Look, nothing is overweighted. Nothing has a higher weight than others. And what do we know from the last couple of months? Moderna is up about 500%. We've got BNTX is also up a couple 100%. We've got all these huge, fast-growing stocks here in IBB, where we've got higher concentrations. So even though we're investing in the same sector, we've got a higher concentration on the one ETF relative to the other ETF, which means this one is still getting the benefit of having a high weighting in Moderna. So that's why it continues to hold these green ratings. So if you're looking at biotech, you want to be aiming for the ones that have got that relative outperformance. So you always want to aim for the green. Don't just go, oh, well, it's biotech, everything is the same. And I think in ETFs, you have to really understand what's inside the box before you start, pushing it out. So, if you look at XLC, for example, XLC is predominantly Facebook and Google. So if you can't trade Google by itself because it's too expensive and it makes your account go a little bit whacked because of the value, just trade XLC. Look for an entry on XLC and trade XLC. XLY is predominantly Amazon and Tesla. All right, so you want to be a little bit careful there because of the high concentration in Amazon. When Amazon starts to turn around, you'll see XLY start to turn around a little bit, and we'll see more green there. So
I've been watching Amazon. What are your thoughts on Amazon right now?
I like it. I think that there's some support that's being shown. I think we'll see at some point it will turn around. I mean, the reaction to the earnings was hard. I mean, this was tough. This was very, very difficult, right? But we're at the bottom of its volatility range, right? So we need to see some exhaustion on the squeeze. Without that, we don't know where it's going to go. So until such time as we start seeing yellow histogram bars being printed on the TTM on the squeeze, there's really nothing to do here. I would just be out of it for a while, wait for it to turn around. I'm looking for the sell signal to be invalidated by a buy signal. We're not really going to see a buy signal until we start seeing the positive stacking of the moving averages. So we need to see the 21 start moving back up above the 34. So, if I put Amazon in here, if you look at Amazon, we've got on the day chart, it's below the 21. On the 15-minute, the 8 is below the 21. On the, on the 5-minute, we've got all this intraday bearish momentum. So until these things start to change, we need to, I don't think anything on the higher timeframes is going to be sustainable. We do see this bearish pattern starting to form on the EMA, so it needs to get those right. The 8, 13, 21 EMAs have to be positively stacked before we can actually start doing anything bullish there. We've got the squeeze on the 4-hour that's triggered, that's gone long, and we've got a squeeze on the 15-minute chart, which is also fine. Now, this gives me some hope that we may see something happen here. But remember, a 4-hour squeeze doesn't last long, all right? So a 4-hour squeeze, if we go to the 4-hour chart and we look at it this way, you can see this reversal. But would you trade this now? No, I wouldn't trade this now, because what you have is this negative stacking. If this was actually above the green, I would probably be more interested. But because it's below the EMAs and the EMAs are pointing downward, the path of least resistance is to the downside. So you can't really go bullish just yet. I would wait for signals to play. Once we start getting positive signals, then trade it. But don't try and time the bottom. You know, timing the bottom it's a fool's game. You know, could you have timed the bottom over here? Well, if you did, you'd still be losing. You know, and then you time the bottom over here, you're still losing. You can't really time the bottom until the bottom is established. So in order to establish the bottom, we need a few more closes, higher highs, higher lows, confirming these candles, moving this up. Once we start seeing this move up and we see momentum shift, we get green bars getting printed. We start seeing a bit more interest. We need a few blue bars on the histogram down here. Things will start to change, but don't rush into it. This is a hard money trade. This is now hard money trading. You know, when is this going to end? You know, you want to try and use a crystal ball. This could chop here for months. We don't know. So we need to have evidence that says, okay, things are starting to look a little bit more positive. Let's move in. We'll take over once we start getting more bullish signals, right? So our alpha score signal keeps us on the right side of the trade. So once we start seeing buy signals getting printed, when we start seeing positively stacked moving averages, slingshot squeezes, we start seeing that EMA starting to get positive, then we can trade Amazon. But for now, I would just hold out, wait, there's easier trades. I mean, some of the things that I really like at the moment, XLV, you know, why would you not trade this? You know, healthcare, one of the best sectors at the moment, one of the strongest sectors. Our put spread indicator got us out of another trade yesterday. You know, are there more trades available? Probably. We've got a slingshot squeeze forming at the bottom here. We've had compression since the last week. So, you know, this looks like it's set for another move higher on XLV. XLK, another one, you know, another buy signal printed yesterday, 2 days ago. We've got a squeeze that's just starting to fire along on the 4-hour. Let's look at the daily. You know, I would much rather be trading these types of trades, these type of trends than Amazon. You know, it just means, if you put those two side by side, which one do you think you're going to make money on first? You know,
I have most of my trades right now are in ETFs.
Yeah,
I like it a lot better because it's a little more low maintenance.
oh, absolutely. Low maintenance. I think it's a much safer bet taking your sort of pool of your pool of trades or your possibility of trades to a higher level, right? If you've only got 11 things to watch, it doesn't take you a lot of time at the end of each day to go through your 11 chosen sectors and see which ones are working. You know, this tool in stock charts is probably one of my most favorite indicators and favorite tools to use. It's just, you go to the RRG, you type in the sectors, you take the S&P 500 ETFs, okay, change this to 1 year daily and move this to the time frame of your average hold period. All right, so my average hold period is between 14 and 21 days. So I usually look at 14, just make this a little bigger. And what you want to do is you want to be moving, you want to be looking for opportunities in the sectors that are red, potentially building in the ones that are blue. So start in red, build in blue, take profits in green, exit when they move to yellow. So if you look at this XLV, you see how it's in yellow now? It's moving, it's going to rotate, it's going to go this way. So with XLV, we've been trading XLV for some time. Oh, sorry, wrong chart. If we go to XLV here, we've been building positions here. We've already taken a 100% gain on the move up this way. So we've already taken our profits. We have a risk-free trade here. What we're looking for is a continuation of that trend. And there's nothing on this graph that tells you that this is going to fall down, all right, at this point. So seasonally, we're in the right trade. We're playing the trade. And as you make your money, you take your money off. Every time it hits the 34, you buy. This is a buying opportunity in a trend that's this strong. Every pullback that we get, whether it's a pullback to the 8, the 21, the 13, the 34, we always have an instruction that says we're going to be adding to our position on any pullback that we get. So the degree of pullback and the value and how much you put into the trade, that's all based on your plan. So a pullback to the 21 might warrant a greater buy than a pullback to the 8. And a pullback to the 34 gets you a bit more than a pullback to the 21. Always keeping it within your allocation percentage, right? You don't want to over allocate to these trades. Remember, there's risk rules. So no position should be worth more than 1 to 3% of your account. So as long as you keep that in mind, and every time there's a pullback, you add, and every time there's an extension, you take profits and you reduce, you will make money. I mean, it's a pretty simple game, but our emotions get the better of us, right? We want to, knock the ball out the park kind of thing. And that's not going to make you money at this time of the year. So XLV looks good. XLK looks good.
You'd like to take profits on your long calls based on the price of the underlying, correct? You set your price levels, or do you focus mostly on a percentage or Fibonacci?
It depends what I decided to do when I first went into the trade, right? So if I go into a trade and my intention is to hit a price target, so I'm wanting the underlying to hit a level, I will take profits when it hits that level, and I write down price movement of the underlying will dictate whether I exit the trade or not. Okay, that's number one. If I've gone into a trade and there's a lot of airspace between where it is now and the next price target, I'll generally look at the P&L of the position, and when it gets to 100%, I will halve the position. So I'll take my capital off the table at 100%, reduce the position down. When it hits that price level that I was going at, I will reassess to see whether or not I should add more money into the trade now that it's going to the next level, or exit the trade fully and move on, or switch the trade. Maybe I've gone from a long call, maybe I switch it into a call debit spread, maybe I turn it into a bull put spread. That all depends on what happens at the time that I do the exit. But I don't just, I don't put on a trade without knowing where I'm going to be taking profits. That's the first rule of trading. Because what will happen is you'll go into a trade and you'll land up either overholding. Overholding is like you've made 100%, you've got 9 contracts, you could easily trim some back and put some money in your account, but you don't. You mentally go, no, I can make more. I can turn this into 1,000% trade. And then the stock reverses. And then it pulls back. It was overextended. It was above the third Keltner. It pulls back to the mean. Your 200% trade is now minus 50%. And now you're sitting there going, I should have done this, or I should have done that. Well, if you hadn't planned, you don't know what to do. In the moment, most people get wrapped up in the greed of the trade. It's like, oh, I can make a little bit more. I'm going to hold on. And then the next day it reverses and they go, damn, I should have done something else. So plan it up front. Say to yourself, this is what my objective is with the trade. When it hits this level, I'm going to do this, this, and this. And when it does that, you do that. You follow the plan. Many people, they don't do that. And I think that's why a lot of people will make sporadic profits. They're not consistent. So, developing consistency in your trading is following your plan. It's not about getting better trades. If you follow a plan of isolating the easy money, following the same rigorous process in building the ponds that you're going to go and fish in, and then following what you said you were going to do, that's a very logical way of doing things, you will make money. Whenever I have a client that says, oh, I didn't make any money, I can generally put it down to 3 things. They didn't have a plan, they are greedy, so they didn't add when they had an opportunity to do it, and they didn't take profits when they had an opportunity to do it. It's those 3 that generally will ruin a trader. So, literally 25 minutes to 30 minutes at the end of each day, once the day candle prints, that's the time to do your analysis for the next day. What are you going to do? Are you going to add to this? Are you going to take some money off? Are you going to you write it down? You could probably build your trades in the aftermarket for loading the next morning. So you do those conditional orders and then you walk away. It's not difficult. The hard thing is people get excited. There's this dopamine that they get from trading, and this is not for druggies. This is not for drug addicts.
So when you're talking long duration trades on these trends, I'm just going to focus on this. So we're talking about 90-day plus options. Is that
generally? I will say to guys, look, at this time of the year, I bring the trades in shorter, so it's 30 to 60 days. My rule of thumb is generally 90 days and 60 delta. Like usually a trend or a plan will play out over 90 days. Okay, it generally will. If you've got a squeeze, you've got all of that stuff, within 90 days it will happen. I don't plan to hold the trade for 90 days. Okay, so that's not the plan. The plan is I buy 90 days of time, but I'm looking to get out of the trade within the next 30 to 40 days. So I've always got that extra bit of time. If things go wrong, and also, if short-term things happen to the position, because I've got so much time, the effect on my position is reduced because I've got time on my side. Shorter duration calls, one-way ticket to blowing up your account, without doubt. If you're buying, 7-day expiry trades and you're putting, 10% of your account in there, you'll blow up your account in no time. So I do a mix. All right, so I focus primarily on the 90 days, 60 delta if I'm doing a long call. If I'm doing a call spread, I have to obviously weight it or design it based on my risk rules. If I'm doing some short calls, there are times where I do 14-day short calls or 7-day short calls, but it's all based on the indicators. If the squeeze is set to fire or it's already firing, or, I've got, my put spread selling signal is telling me to do a trade, or my alpha score indicator is telling me to do a trade. And looking at the different charts, I've got more probability of winning in the short run. Or let's say that there's a trend that's starting now. I don't want to do it over the 90 days. I'm going to do it over 30 days, but I'm going to exit in 7. I will do those trades. But it requires practice. There's some nuances to doing shorter duration trades. So for beginners, go out 90 days, buy the 60 delta call option between 60 and 80. All right. Always be conscious of what you pay for the extrinsic value of your option. If you're buying long calls, try not to spend more than 30% of the premium on time and volatility. All right. Just keep it down. Don't overpay for that. Because remember, by the time that option expires, that will be 0. Right. So that's 100% write-off. Right. So if the stock does nothing, that's how much you're going to lose. Right, you're guaranteed to lose it because the rest is intrinsic value. So when you build your plan, if you're going, well, I'm going to spend, 10% of my account building trend trades on the SPY and QQQ and DIA, do them at the 90 days, and every 30 days, roll the trade. Just roll the trade. If it keeps trending in the right direction, just keep taking profits and rolling the trade. At some point, you're going to have a risk-free trade. And that is my goal, is if I can have 20 to 30 positions that are risk-free, that have been paid for by profits, not capital, that's ideal for me. That's where I like to trade.
When you're saying roll the trade there, do you mean an actual roll? Or
no, just extend the trade. So sell the trade.
Close the trade and buy a new trade.
Yeah, buy another 90 days. Yeah. So it's often what happens is people get fixated on, but I like doing, this strategy or that strategy or whatever. All strategies work. There are many, many roads to the top of the hill. Okay. My methodology and what works for me might not work for everyone. All right. It works for me. And what I try and teach people is you have to find that space where those trade plans make sense to you, number one, can be followed. So you've got the discipline to follow it, and B, it gets you your results. That's the only thing that counts. That, at the end of the year, did you get results? Yes. Okay, cool. Then it's working. Keep doing it. If the question is, did you get results? No. Well, stop doing what you're doing and do something that's going to be different, because, just keep on doing that and you're going to keep getting bad results, right? So for beginners, you should start off with very, very basic elementary trades. All right. Basic long calls, basic call credit spread, basic call debit spreads, put spreads. Those would be the three that I would say, as a beginner, you need to master those, because everything else will fall from them. All right. So, if you can't do a call debit spread and get directional trading right, you shouldn't be messing around with butterflies. Okay. Because they have an element in them that is the same. You've got to be able to interpret charts, and you've got to be able to be pretty good on directional trading, right? So you've got to get your directional trading right as a skill set. You've got these tools that you build within that skill set. And then you gradually add more sophistication to your trading plan as you get more experience. Too many people try and get too fancy, too quick without knowing the beginners. I get pretty annoyed when I see guys doing, a lot of beginners go in and sell naked puts, cash secured puts. And I'm like, if there's one thing that will blow up your account, it's that trade, right? Naked puts. I've had more clients come to me having losses on naked puts than any other trade strategy, because it's an easy strategy to sell, right? It's an easy strategy to sell. Pick a stock you want, buy it at a discount, sell calls, whatever it is. I'm like, yeah, okay, it works. But then when everything reverses against you and you're stuck with a pile of crap for the next 6 months that you can't sell call options on, how did that work for you? So the problem is, it's not that in theory it works. The problem is that most people oversize the trade. They take on far more risk than they should. All of a sudden, they're sitting with 3,000 shares in a company that lost 25% because they held through earnings. Now they're going to sell call options on it and try and recover their money. It's not happening. It's not happening. It can derail you really, really quickly. So rather than that, what I say to guys is you need to split your account into two different strategies. If you're looking to buy and hold shares and you're going to use, cash secured puts for that, great. Do that somewhere else. But that's not trading. Okay, that's not trading. That's buying shares at a discount and holding it somewhere else. All right, you're not going to make a lot of money doing that. You might get your 5 to 10%, or 12% a year kind of thing, if that's what you're out for. When people trade options, you're looking for exponential growth in your account. You're not looking for 20% a year. Why would I do that? I wouldn't want to take the time to do that. And it's a lot of work. You think I want to be sitting there holding, a steaming pile of garbage and try to sell calls on it, 30% under my purchase price and wait till I get assigned? When people say eventually it turns around, sometimes it doesn't. Tell that to a guy who got assigned Tesla at $900 and ask him how well his call option selling is going. That's what I try and say to people is like, if you understand the risks and you're willing to accept it, great. Doesn't work for me, but it works for some people because that's what they're looking for. So when you have a strategy and you're trying to build your plan, know what your outcome expectation is going to be so that the plan that you have is going to deliver what you expect it's going to have. If you've got an idea of trying to triple your account every year, you're not going to do it by selling cash secured puts. Okay, mathematically it won't happen. So you've always got to match up your expectation with the strategy that you're using. If you want to triple your account in a year, you need to do long calls and you need to do call debit spreads and directional trading. You have to do it. Even call debit spreads wouldn't be used, but long calls would be used. Long calls are going to give you your triple digit gain. They're not going to do it you can't do it on cash secured puts, because the margin utilization is too high and your premiums are too low. Like all of these things start coming in. So with clients that are looking to have, the big gains, they have to have the skill set in order to achieve the big gains. Otherwise, they're not going to get them. Then at the end of the year, you sit with them and say, did you achieve your goals? And they go, no, I was expecting to triple my account. Okay, what did you make? I made 25%. Okay, why was that? And they go, well, I was only doing this strategy. Okay, well, that strategy isn't going to work. You've got to, if you don't match them up early, you're just facing disappointment at the end of the year. So that's a big reason why planning is so important. And don't get fooled. Like many times I see people, getting suckered into the latest trend on the internet, listening to a whole lot of stuff. It's just, good luck to you. If that's what's going to make you money, good luck. Give it 3 months, try it out. If it works, fantastic. If not, stop what you're doing, start writing a plan, start being practical. This is a business. It's not this shouldn't be done like, if you've worked hard for your money and now you want your money to work hard for you, put in the effort, man. Like really, so many people are just willing to throw money away. When I hear people come to me and they go, I've got $100,000 and I'm willing to lose it, I'm like, my God, I don't want to lose anything. Like, I'm not willing to lose anything. Like, why on earth would you approach trading with a loser's mindset right up front? Like, no, the objective here is not to lose. So you need to trade not to lose. When it's like the thing with stop losses. When you go into a stop loss, when you put a stop loss into your account and you've told the market makers and the brokers exactly what your point of max pain is going to be, where you are quite comfortable losing 15% on a trade, and you've told the broker and you've put the order in, and then they flush you out and you lose 15%, and you come home and you go, yes, I lost 15%. And you go back and check the market and it actually closed up for the day. How does that make you feel? It's pretty crazy, right? So that's why we don't do it, because that's the way it's rigged against you. So you've just got to be aware of this stuff. I mean, I know I'm
Why do so many people use stop losses, do you think?
What's that?
Why do so many people use stop losses? I know
because it's written about it in books. Like, everyone reads the same books. It's like, I'll be honest, when I first started learning how to trade, I was reading the books and I was doing exactly what they told me to do in the books. I've got a whole list of books that should be banned. Just like, people wouldn't go and read Mein Kampf or whatever it is. I've got a whole list of options trading books that should never be read by anyone. Like, honestly,
what's the worst options trading book, you think?
Well, no, I can't do that, because if the author is watching this and he hears me say that, I'll get sued. No, if you want to know the books that I put on my blacklist, you can email me in private and I'll tell you. But man, there are a plethora of books that you should just avoid. Like, if I could put a list of books on Amazon of what not to read, there would be, it would be at least 100 books. Because the problem is this: in the books, they're telling you stuff relative to a market that was relevant years ago, not relevant today. Like, I was doing exactly what they told me to do in the books, and you know what? I lost money. So was it me or the book? Because I did exactly what the book said. So, the thing with stop losses is, if you know where your point of pain is, it will give you the confidence of being able to come back tomorrow. But stop losses are not insurance for stupidity. That's the way I look at it. I go, well, if you went into a trade and you've got a stop loss and you've put it in and told your broker where you are willing to lose that 15% and they wipe you out at that level, you never plan properly. That's the way I see it. You should plan your trades properly, because if you're looking at the right indicators, if you've got the right structure and all of that, an algo flush to that level should not trigger you to get out of that trade. It shouldn't. An intraday movement should not trigger a day chart exit. That's the way I see it. If I've gone into the trade on a day chart and there's an intraday flush to the point of max pain for me, I deserve to lose. If I put that trailing stop loss in, I deserve to lose. So a lot of people do that. They manage the trade on the day chart. They go in on the day chart, but on the intraday, it flushes to that point of pain, gets them out of the trade. But on the day chart, it ended up for the day. They lost 15% and everyone else made money.
So I have a question about, so stop losses kind of have a long history. And I know you could do them for a while, but I mean, recently with the algorithms, like when did the algorithms, do you think, start hunting stop losses? Because they probably weren't as, you think they were as bad as they are now, before the algos were hunting the?
I don't know. I think everyone knows who reads. Everyone knows what books they read, right? So everyone knows that the stop, if I go long here, my stop is down here, right? So if this flushes down to this low, it's going to take me out. It's the same thing with shorts, right? So, if I short over here, my stop loss is going to be somewhere over here or here, right? And as soon as it breaches that, the guy that's shorted in the hole, he's out. He's lost money, right? So I think, does it, I can't really say, I don't know. I look at it and I just go, if you're a trader and you're in your business plan, you've put in there, I'm willing to lose 15% of my money, and you think it's a great idea to tell people that, I can guarantee you they will take your money. It's that simple. So if if you've got a stop loss mentality, keep it in your head. Just don't tell anyone.
Like
If I told,
card game.
what's that?
It's like showing your hands in a card game.
Absolutely. It's like me going into jiu-jitsu, into a competition, and saying to the guy, listen, don't touch my knee, don't touch my shoulder, don't touch my arm. You can go for my neck. He's gonna go for my knees, man. Yeah, I've just told him what's gonna hurt. No, I just think at some point, many traders just have to face up to the reality that you're at a disadvantage. Why are you giving away? The one advantage we have as retail traders is we have liquidity that we can move quickly. These big fund guys, they can't just sell $9 billion worth of Apple shares. They can't do it. They have to do things, under the cloak of darkness kind of stuff, right? We can move. Why on earth would you tell these big players where your point of pain is, where you can say, okay, I didn't feel so bad, I lost 15%. I would look at that and go, I've just been pillaged. I would be like, that's, my village has been ransacked. It's just, you don't tell them. Keep it to yourself. Put it in your plan. I usually tell my clients, have a mental stop loss. Do it in your head. Know where your point of pain is. Go in when it hits that price point and look at the indicators. Get the big picture. Has the structure changed of the trade? Is the stock now trading in a completely different direction from when you went in? Yes, get out. Much more practical.
Instead of sending a stop loss order, you just alert in. Yeah,
for sure. Absolutely. First bit of advice that I should have been given 10 years ago, but I wasn't.
So what are your top things that you're looking at, say, for the rest of the week, maybe next week?
I'm really liking Apple. We've got quite a few trades on Apple at the moment. Nice consolidation that we have here, potential breakout there, squeeze firing to the upside. We've done already a 100% gain here on eBay. Another breakout here as well on eBay. We've got a risk-free trade that's up around 200% now. XLK, which is primarily Apple and Microsoft. But, if you don't want to trade Apple, this one also looks ready to move. XLV is another one. Healthcare. We've got two trades on as well underneath. We've got Pfizer. We've got some trades here on Pfizer, and I think we've got it on Bristol Myers as well. Here we've got a buy signal as well that came out. So really like this. This squeeze has been, wow, since the beginning of July. So, here it is in the 34, right in the range that we like to buy in with a buy signal on the alpha score. I think that this one looks pretty good. What else? I'm just going to open up my ledger here and have a look and see what else I've got on the cards. And let's see. XLP was something we added onto yesterday, the consumer staples. I do like the look of consumer staples. We bought yesterday. We added yesterday. I would have preferred on a lower price point, but what I was looking at was this histogram that was starting to fire along. It looked really attractive. So XLP is definitely on the cards. SMH in semis. Here we're in the buy zone. We have a sell signal, so I'm waiting for this to reverse out. I'm waiting for a buy signal. Squeeze looks like it's moving down, or histogram's moving downward. So just waiting to get a buy signal here. We'll probably see it somewhere around 255. If this can push down to 255, I mean, it's a big jump from 262. I'm just looking here. UNG is another one. So natural gas, really like this. I'm just waiting for that to be invalidated. So I'm waiting for a buy signal. If we can get this to push down just a little bit more, plus get some red. I'm looking for red now on the squeeze. Once I get some red on the squeeze and I get the yellow, the slingshot, this will be a buy signal. What else have we got here? So eBay we talked about. Yeah, Johnson & Johnson was the other one, not Bristol Myers. So J&J, we added some J&J yesterday. I just like this trend. I mean, there's no indication that this is coming back soon. I would have preferred to have got it down here, but this breakout was really strong. So let's see where, if we can get this, you know, on a pullback, we'll add some more. Let's see, XLC, the communication ETF is also another one. I really like this. It's not doing much. Obviously, Google and Facebook are the big constituents. So if we look at Google, you know, we can see this sort of consolidation that we have here. Really big range yesterday, closing up lower than Friday. So what I'm looking for here is a little bit of either a squeeze starting to form now that we've got this compression, maybe a pullback down to 2641. Doubt that's going to happen. I really don't think it's going to drop $100. So, you know, we probably need to go in at around 2710, possibly 2675 if we get the pullback. All right, this is every time we've had a pullback on Google and it's been a buy opportunity, it's been a winner. So it's a very reliable signal for us, waiting for the alpha score. Let's get it in and take it from there. What else have we got here on the, let's see. That's probably, oh, ITW was a trade that we did last week. We added this last week on Friday. Somewhere around here, we added the trade. We've had the breakout move. The put spread signal from there was taken from May, was taken out there. So not really practical by any means. No one would have done a 6-month spread, so, or 4-month spread. But what I'm looking for is for this sell signal to be taken off and a buy signal to be given. So what I'm looking for here is the squeeze maybe to fire long. We've gone from a high compression to a low compression. So now I'm looking for a new bar with maybe a green dot. If I can get the green dot, this would look good. Industrials, you know, if we look at the XLI ETF, you know, here's our, we're on a sell signal still. Look at the range of yesterday. It was huge. Buying opportunity when it hit the 34. See, this is the thing. Most people don't look at that price trigger down there. They're not waiting for this. You know, they'll look at this candle and go, oh, it doesn't look too good, I'm not going to add. But if you had a conditional order, buying the call option at the touch of the 34, that would have been a great opportunity to buy on XLI. So that's about it, really. There's nothing else. You know, Apple, I would probably say Apple, Microsoft, XLK, XLV, those are the big ones. If you can, you know, focus on the easy money. You know, now's not the time to be over risking anything. We've got some of the Fed members talking today. So, you know, today is not a, it would be a sort of warning day. Don't do anything silly. Don't oversize stuff. We've got Bostic that talks at 10:30, and he's, you know, he has the ability to sometimes move the market. Sometimes these guys, that, you know, they just say the same thing over and over again. You know, it's not very exciting, but if you're doing any intraday trading, you need to be aware of that. But yeah.
What about September? I mean, you said generally, and I know we don't have a lot of time, but just what should we be looking to do to plan for September as being a seasonally month, bearish month?
You know, the hard thing is this, right? Just like calling a bottom is hard, calling a top is even harder. And I think when you start to try and call a top, you've got to be prepared for a couple false starts, right? You're not going to win on every time that you try and hedge the market, right? Biggest money I've ever lost in my trading career is hedges that have gone wrong. You know, when you completely convinced the market's going to go and crap the bed and fall out, and then all of a sudden you've paid 10 grand for an insurance contract and it doesn't deliver, that can be pretty painful. So what you should be looking at is looking at the 30 delta long put debit spreads. sort of 90 days out on SPY. Hedge on the indexes, don't hedge on individual stock. Rather hedge on the SPY, the QQQ or IWM. But 30 delta, a 30 delta move or a 30 delta put spread, bear put debit spread, would probably put you in around the expected move, and it would give you a pretty good risk reward. We've got a couple on small caps and tech, purely because we just can't time it. I don't know when the market's going to fall, but I know this: when the market does fall, it's not going to give you a flashing neon sign and give you time to get in. It's going to gap down horribly, and when it does fall, it's going to fall hard. So you've got to be in with your insurance positions way ahead of time. And sometimes that's the risk that you take with those insurance trades, right? Is that you could lose on 3 of them, and your last one that you make, you can literally triple your account, right? So you've got to be prepared for the write-off. That's why we would use the 30 delta on the put spread, on the put debit spread, rather than in the money. I don't want to be in the money. I'm going to land up overpaying. And if I overpay and I lose, I'm going to lose more. So, it's all about practicality, right? You could do some cheap put butterflies as well. But that requires a pin to pay off. I'd rather just stick with the debit spread and, roll it every 20 days if it doesn't pay off. That's what I would do. But hedge on the indexes. Don't go for stock.
If you do accumulate some profits on, I know IWM, the bear put spread is starting to
just start rolling it out. Don't obviously with that one, there's still a huge amount of time, right? So you can hold back on that, let it accumulate a little bit, and then sell it later on. Give it some time to accrue a bit of profit, and then move on. Don't be in a rush to reset things, because remember, when that price falls and you're starting to accumulate profit, your cost of resetting is now going to change because the puts have now become more expensive. Okay, so you just don't want to overpay for your secondary contract. Sometimes staying with the first one is the better idea. So, stick with that. But awesome stuff, man.
Well, Chris, we'll let you go just a few minutes before the bell. And I look forward to talking to you next week. And I hope you have a great week.
You too, my friend. Take care. And I love the light. It's making you look very, very angelic, Brian.
One day I'll fix this. Until then, we'll just let you give them great information, and they can ignore my head.
Awesome, man. We'll get the chorus of angels to sing every time you come on, man.
Exactly. Hey,
take care, my friend. See you soon.
All right.
Bye.